Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Hello and welcome back to another episode of Blue Chip Now. I am Daniel Dusina, Chief Investment Officer.
And I'm Matt Mondoux, Senior Financial Advisor and Partner.
And I'm Dan Seder, Managing Partner.
So for today's episode, we wanted to provide a rough overview of financial markets over the last month or so here in the U.S. Specifically, we're going to start with talking a little bit about what has aided in the recent rally. We're going to talk about international markets and emerging markets, specifically from the perspective of those areas have been seeing record inflows and also partially outperforming the U.S. We want to talk about some expectations for the future as well, even though this will be more or less a monthly recap, but some items for the future, including a massive pool of cash on the sidelines, talk about economic data, what that can be telling us about the path forward, and ultimately what that can be telling us about the Federal Reserve as they look to meet in September. So, a lot to unpack today, but we'll try to make it smooth and insightful for everyone involved. So, to start things off here, we have the U.S. equity market that continues to scale to new heights. Just last week, you had the S&P 500, the Dow, and the Nasdaq each hit record highs. You have renewed optimism around potential Federal Reserve rate cuts. I would call it moderate July inflation readings, really good corporate commentary and earnings in general. And you have this earnings trajectory for mega cap tech like Nvidia and Microsoft that continue to fuel the rally. I mean, what do we make of all this? I mean, this is a V-shaped recovery after the tariff tantrum, and now we're back to all-time highs. What do we make of this?
Yeah, so what I would say, Daniel, is there's a tale of two emotions when stocks are at all-time highs. You have a number of investors who get nervous because they don't want to invest at the peak. But I kind of look at stocks that make 52-week highs as extraordinarily bullish momentum. Statistically, companies that go out at 52-week highs continue to do so they keep moving up. So I look at it as a hugely positive development. I think markets continuing to be strong. It's positive momentum, and I think it'll continue.
Yeah, so two things really quick, from my weekend reading that reinforced Dan's point. When the U.S. So we're at a 68 consecutive days that the S&P 500 is above its 20-day moving average, which is a measure, in essence, of short-term strength in the market and momentum. That's only happened 9 times since 1957. This is one of those. And on average, the market's 12 months forward return is 11%. The other major thing here to talk about, this isn't just on nothing, right? There is actually data and earnings that have backed this up. We have the S&P second quarter earnings in aggregate are up 11% year over year versus expectations of 4%. Obviously, there's a lot of uncertainty.
So hugely strong. Hugely strong.
On top of that, 92% of companies have, with 92% reporting, 60% have beaten their earnings by more than a standard deviation. Yeah. So incredibly strong. A lot of that's been aided by a weak dollar. Dollar's been down. That's certainly favored large cap companies.
Yeah, well, and I think so coming into this quarter, expectations across corporate America were very low, which helps make some sense of what Matt was just talking about in terms of companies beating earnings expectations. Certainly with the bar being low, it makes sense to see some of those earnings beats. The other thing I would say in terms of rationalizing the V-shaped recovery and the recent strength in equity markets, it's been very much founded upon corporate commentary that has been a lot clearer than we got the previous quarter. So if you rewind back to the first quarter, corporate America and the management teams within were grappling with a whole host of uncertainty around tariffs, what that would look like for the rest of their company's year.
Dual guidance.
Right, giving guidance for what it might look like if there are not as impactful of tariffs, and then also giving another set of numbers that equate to a more severe tariff scenario. I think part of the confidence that you've seen displayed by investors does relate to the fact that you've been seeing management teams not just reinstate, but potentially lift full year earnings guidance, which to me is one of the biggest confidence boosters that you can have. Just one of the biggest votes of confidence from management. So synthesizing everything, I mean, I think that even though you have a market, depending on which index you look at, has hit all-time highs, I just struggle to find major reasons to try to time the market and wait to buy the dip, so to speak.
And,
right?
I guess, like, interestingly too, kind of moving on to some of the other talking points for today, retail investors have not been passive here either. I mean, we are seeing the junk stocks, the meme craze, along with diversification, right? So international has worked this year. Emerging markets have worked this year. So maybe we could, talk about that a little bit.
Well, yeah, and I think the whole buy the dip craze has very much been on display this year. And you don't really get a V-shaped recovery like we saw in April without retail investors exhibiting that buy the dip mentality, right? So I do think that that's an encouraging thing to see in general. The other thing that you called out, Matt, even though the market has been driven by, call it big tech and your household names like Nvidia, Microsoft, Amazon, et cetera, it's not like it has been as concentrated as we've seen in some years past, namely call it 2023 and then even a lot of last year. Some of the junk, I wouldn't just call it junk, but there is participation from other companies across sectors, across the board that are lifting the market, which to me, as I've always said, is a much healthier semblance of a market than a market that's just led by 5 or 7 companies. So it's encouraging to see that as well.
Yeah, and examples of those junk companies, Business Insider has Kohl's and Krispy Kreme. So people are buying their donuts.
Right, was Krispy Kreme partnering with McDonald's or something along those lines?
Yeah.
And huge news there. But also, I think more healthily, you're seeing, like we said, emerging markets. Emerging markets have actually outperformed the U.S. markets this year to date.
Yeah,
so,
that's a phenomenon we have not seen in a long time. At least a trend that has persisted at the length it has this year.
Yeah, having a non-centric U.S. investment portfolio is actually paid this year.
Yeah,
Matt, according to Reuters, emerging markets saw massive inflows in July, around $55.5 billion, the second largest monthly total in 4 years. That's a big inflow.
Yeah,
Wow.
Emerging markets is almost like international markets on steroids. For those who are not as intimately familiar, developed markets versus emerging markets, there is a delineation there. So your household markets like Germany, France, et cetera, across the pond, those are what we would call more established developed markets, whereas some of your smaller, less prominent in the business realm markets, those are emerging markets. So they are kind of like the difference between large cap stocks and small cap stocks in any environment, right? They're going to be a little bit juicier, a little bit more volatile potentially. Emerging markets, though, one thing I would call out as a differentiator, they do tend to be even more impacted by swings in the US dollar than the international space in general. So the international markets in general will be impacted by moves upward and downward in the US dollar. Emerging markets even more so, and I would just say to a larger degree. So as you see something that Matt called out about this year with the US dollar trending meaningfully downward throughout this year-to-date period, it's no surprise to see investors not just flocking, but taking interest in emerging markets this year.
Okay, so let's talk cash. We're talking dollars, US dollars. Let's talk cash. What's the number right now sitting on the sidelines?
Yeah, so again, according to Bloomberg, Business Insider, anywhere you looked, $7 trillion is parked in money markets. $7 trillion.
And so there's so many things we could talk about here, but if the Fed cuts and the rate that is paid, the interest that's paid on money markets declines, you might see investors pulling from money markets and redeploying that cash into stocks. That could be hugely bullish.
Or bonds. I mean,
Or
bonds could start to do well. So it doesn't just have to be stocks.
Yeah, I mean, you see this trend happen more meaningfully once you get actual shifts in interest rate paradigm. I mean, you can look back to the early 2000s. You can look back in the early 2010s when we shifted to a zero interest rate policy. You did see some fits and starts over the last year and a half in terms of certain periods where you saw downticks in the usage of money market funds upon the assumption that Federal Reserve cuts were imminent, right? So it would not surprise me if over the next year we do see some drawdowns in the actual level of money market fund usage. Because to me, I mean, the value proposition of a money market fund, as it starts to decline from an interest rate perspective, just the value proposition lessens. And your hurdle rate for a fixed income asset, whether it's a mutual fund, ETF, or an individual bond, or even an individual company that's paying a certain dividend yield above that money market fund yield threshold, the value proposition just deteriorates a little bit, right?
Yeah, and it's not like bond yields are really all that attractive where you're not earning 8% on an investment grade corporate bond, a 10-year investment grade corporate bond versus 4% in a money market. They're close enough where I think people, and sensibly so, are just feeling comfortable parked there versus taking a little more risk. But that can change.
Well, and I would say the last kind of point on this is that because of that massive mountain of cash, I mean, it's almost $7.2 trillion as of last week. That can actually end up being a ballast for markets in general. So who's to say if any of that drawdown in money market exposure ends up splashing the bond market or the equity market domestically or internationally? We can't really say. But either way, if you do get drawdowns in that money market fund usage, it will go somewhere else.
It's going somewhere.
And it can serve to put a little bit of a floor under certain financial markets, right?
Well, it's like water. Money tends to flow to where it gets treated best. And if stocks are still showing signs of positive momentum, I have a feeling that money is going to come out and go to stocks.
Right.
How about the economy? Any contrarian signals? What are we seeing on the economic front?
It's been a lot of back and forth, I would say. And when I say back and forth, I mean certain pieces of economic data that might paint one picture, and then just that same week or the week following, you might get prominent economic data that points towards a completely different picture. I think the most recent example of this was at the beginning of August. We got a jobs report for the month of July that was pretty wild in general, not just from the perspective of a very weak print on the number of jobs added through the course of July 2025, but the number of negative revisions to previous job additions that were talked about for May and June, to the tune of nearly 300,000 jobs that were actually not added, even though they said they were when these numbers were initially released. So this is a hugely pessimistic piece of commentary from the labor market in the U.S. because you basically had data that was telling you the labor market here in the U.S. was still very healthy and expanding, not rapidly, but at a healthy level month to month. That is now telling you that that's just not been the case. Labor market has contracted meaningfully. Unemployment has ticked up, not materially, but at least a portion or a little bit. And so you kind of counteract that very weak report with retail sales, a snapshot of the consumer that's continued to be very healthy and very strong, and inflation that has been more or less managed, relatively fine. So it's very, very challenging to paint a very clear, clean picture of the domestic the domestic economic landscape right now. And it's giving the Fed a very challenging job.
So what does the Fed do now? So maybe we can wrap it with this. We're up against a dilemma. There's a political tug of war between Trump and Jerome Powell. And as Robert mentioned, it's not just Jerome Powell that votes. There's a voting committee. But the political environment is the Oval Office is placing a tremendous amount of pressure on the Federal Reserve to cut. And so what does the Fed do?
And Daniel, I think you had a really good analogy for this morning. In a lot of ways, what the Fed is trying to do is decide if they need to wear a raincoat in March, 6 months from now. Mm-hmm. Like they're trying to predict the weather 6 months from now. Is this going to be necessary? Do I need to wear this? It's really tough. I mean, we've heard, up to now 150 or so 1.5% cutting, from the Fed, which seems crazy.
But 25 basis points is baked in.
That's the expectation right now, at least.
85% chance that a 25 basis point cut in September. Yeah. Okay. Yeah. So, and what you'll see is probably a tick higher on the 50 basis point cut as the date nears. But if it really, at least at this point, if anything's on the table, it's a 25 basis point cut. And Geez, oh, Pete, I feel like that's going to be stimulative to the stock market as well. So got to be careful what you ask for.
Yeah, and I think you have to also question how much of it already has been stimulative. Of course, like buy the rumor, sell the news.
Yeah.
As well. There's probably the ability for a surprise and a larger rate cut than anticipated. I think the one thing that you're starting to see more and more stories come out, but just because the Fed cuts rates does not mean that your mortgage rate, your refi opportunity is going to increase or be better for you.
Why?
Because ultimately, the Fed can control the short end of the curve. They cannot control the 10-year, the 30-year, mortgage. That is going to be driven to a large degree by supply and demand. At this point, with mortgage rates around 6.5%, between 6 and 7%, the demand for mortgages has been perfectly strong.
So the Fed cuts. If the Fed cuts, the short end of the curve goes down. It doesn't necessarily mean that mortgage rates go down in corresponding fashion.
Exactly. And if that's what people are expecting to come out of this, I think people are going to be disappointed.
Yeah, it's possible.
Yeah. I'll wrap us up with just a quick summary. So just to kind of recap what we've been talking about, over the last month, we've had U.S. markets that are marching higher. Mega cap tech certainly has been additive, but it really has been other things as well, like retail investor optimism and a more broad rally in U.S. assets. We're also seeing strength in emerging markets and the international markets, a lot due to the U.S. dollar trends that we've seen this year. We also have a massive amount of cash on the sidelines that here at Blue Chip, at least, we're making an assumption that can end up splashing either the equity market or debt markets here in the U.S. And then finally, just on the economic front, there's still a lot up in the air, but it does look like we're trending towards a period of interest rate cuts from the Federal Reserve starting as soon as September. Thanks, everyone, for tuning in to another episode of Blue Chip Now. We look forward to speaking with you again next time.